All right. Good morning, everybody. We got ADP today. It's another projection of employment. This goes to the conversation that we've been having, and the markets are using it to unwind a little bit. They had priced in another 75 basis points for the year, with the two remaining FOMCs, one being a 25 basis point cut and the other one being another 50 basis point cut, combined to make a 75 basis point. But it's being unwound. The markets are starting to get the hint with the nonstop Fed speakers out there beating the drum that they want to cut slowly. Cut a little, wait and see, cut a little, wait and see. So we're looking at the November, and then we have the December here. Those are the last two FOMC meetings on the year, and we can see these projections of what the market has been doing. You know, if you listen to traders talk and they say, oh yeah, it was already priced in, it was this. When I was new to trading, I used to hear that kind of talk and I would think, how the hell do you know what's priced in? What does that mean? Where did you get that information? And this is what they're talking about. You can see it, right? So this is a free website. Just Google Fed Watch and you'll get it. It's from the CME group. This isn't the only place to go, but it's one of the most popular, especially since it's free and you can change the way that it looks to present the data a little differently. You got 1 month, 1 week, 1 day, and where we are now. So you could see where we were like a month ago, and the idea that by the end of the November 7 FOMC meeting, we would be at 4.25 to 4.5 at a 10% chance of that. 1 week ago, we were at a 57% chance of that. So they really ramped it up after the last FOMC, and now they're dialing that back. We're now hovering around that 36, 37 range. What they're increasing, on the other hand, is the chance that we'll be at 4.5 to 475. That was lower a week ago. It's higher now. The likelihood that we won't get as many cuts is what they're pricing in. So they're unwinding some of that. It's worth a glance from time to time. It's not something that you need to sit and stare at all day long, right? It's just come in, take a look, and if you feel a little overwhelmed with it, just look at one of these numbers. It doesn't matter which one you choose. Instead of reading it as a spread, just choose the lower number or the higher number, and then it makes it a little easier to read. So current rate is 5. If we get a cut of 75 basis points, then we would go from 5 to 4.25. And right now, that's the highest probability, but again, it's being unwound, right? So we're seeing that go down, and we're seeing the other one rise up a little bit. Right now, this one is the one that's on the rise, that we would go from 5 to 4.5 instead of going from 5 to 4.25. Japan's going to have its 10-year auction tonight. JGB, it's worth keeping an eye on. And we've seen some overnight moves come out of Japan. China had holidays, so they were closed. If you're ever curious about, is a market open today? There's a website called Trading Hours. This is also a free website. You can see the markets that are open, if they should be open, if they're closed, what the holiday is. And it's not just these names here. You can search for whatever you want. You can just see all the markets and pick the one that you're interested in looking at. And it'll tell you their time frames in the local time, which I find really helpful. So for an example, if we look at the Hong Kong Stock Exchange, we can see how long until the next market open. And I can just compare that with my own time frame, do the math, and figure out when they're going to open. I don't have to worry about crazy time frames like GMT +8. I don't have to worry about it, right? I just take that and subtract it from my own hours, and I can see when they open. It has their hours of operation, and if there was a holiday, it'll say it, right? Next week's a holiday, next month, market's closed today for a holiday. Thinkorswim has market hours like this. It'll tell you nations around the world when they open, when they close, but it doesn't honestly check to see, did they actually open? Are they on holiday? Is there, some reason that they're not trading today? So I'd rather go here. Besides, it's free. It doesn't cost you anything. So Japan, Hong Kong doing good. Europe's kind of flat. We're going to get more out of Europe today. It's been nonstop with that. S&P and NASDAQ basically flat, and small caps getting murdered again, down 0.75%. There's a lot of talk that after the Fed starts to cut rates, that small caps do better and, they get the resurgence. Well, I don't think they got the memo yet. So, don't just lean into that by default. If we look at Market Watch, which only focuses on the biggest events and only US events, we can see ADP first thing, and we're looking at an increase in jobs. Markets will like that. Then it's all Fed talk. We're pretty much done by 1 o'clock though, which is a pretty good time frame to keep your eye on. Come over to FX Street. They do more of a global perspective and get a little more nuanced with smaller economic events. There's the 10-year bond auction tonight. And then we're also going to get foreign bond investment. So it's worth being aware of when it comes to Japan. It's going to be hitting with them all week. We had ECB lane. So European Central Bank chipping their teeth. We're going to get crude oil inventories. And with the Middle East conflict, we can see, crude's made some wild moves. Just remember that it is short-lived, short-term wild moves. It won't keep those runs. So be ready to get out of your longs and or flip to shorts. Some of the move yesterday was because of the Middle East conflict, and it's not done, right? Everybody's now waiting to see what Israel's going to do. A little bit of tit for tat. So if that news hits today, you could expect the markets to again react. Be ready for that, right? It's hard enough to trade when we have the flows to read and to play the moves that we get. But a lot of times that sort of news will hit, and before we can even see any of the flows, we're already making the moves, like yesterday on that drop. This is today's structure for the ES. I didn't turn on any of the levels yet, but simple enough. We got the half back of yesterday and then marking it from its highest to its lowest point. And then getting the LZ from that. Simple enough. If we were to turn on the spot gamma levels, we're underneath the volatility trigger. We're barely above 0 gamma. And on things like the NASDAQ, I think we're already in negative gamma. Don't quote me on that. I still need to line out the charts for the ETFs for the day, but we are underneath the volatility trigger. And put wall 56, 52, it's higher than it was, right? This is called rolling up the put wall. Generally, we would see rolling up the put wall as bullish. But with that move down, it kind of took the wind out of the bulls a little bit. That was a heck of a gut punch. We're underneath the 10-day moving average on the ES and the NASDAQ. Dollar back above 101. So it's kind of worth keeping your eye on. And we got the 2-year making waves. We want to see if that dollar is going to fade back or not. See if the VIX is going to fade back or not. So it's worth keeping an eye on these markets. The dollar, the VIX, the 2-year, maybe the 10 if you want to go a little farther out. There's the ADR levels for the day. We're closer to the lower one, which implies that we would go down there and hit it since we're already closer to it. But we would have to break yesterday's low to do that. So that's a stronger pivot. We've already seen them front run that low. They stepped in front of it. Liquidity resides on the other side of the pivot. But that doesn't mean that they can't front run it, especially if it's a cog line like 5732 cog line. So they stepped in front of it. If we come down and retest it, it's very likely going to be on the other side. That would put us in the liquidity zone, and then we would hit the ADR half anyways. There is a concept that suggests if we hit one side early enough in the day, we can hit the other side by the end of the day, which happens to be another cog line, 5792. I'm not saying we're going to do either one, just that if we're this close, we likely go ahead and hit it. And if we hit it early enough, it's very common to come back and go to the other side and hit the other one. The central pivot ranges, it's worth noting, and I mentioned it Monday, that the week's pivot is very narrow. So a narrow channel implies that if we break out or break down, that it can grow legs and really run. Normally, the weekly pivot is not so narrow. And I mean, it's a pretty narrow one. We tend to focus on it on a day-to-day basis, not on the weekly when it comes to narrow channels or not. But it is a narrow channel, which implies that we could get some big moves on a weekly perspective, breaking out on the week above or below last week's range and really expanding. So consider that if, when we start to test the edges of last week, kind of asking that question, are we still within last week's range? And if we are, and we break out, where are we going? Where's the next stopping point? $5,700 is a 50% measured move of last week. And since we are IX10 at this point, the halfback 5732 of this really big bar. We get below, call it 5675, then we'll come down and get this gap closed by some wild moves. 5626. We are setting up right now for my failed flag play, but there is a little asterisk on that we'll get to in a minute. The day's central pivot is really wide. That implies if we break out, that the breakout won't stick, that it'll fail and we'll come back in again. Keep in mind that these channels and pivots and levels, none of that holds true in the face of news. So, Middle East conflict, bad job numbers, any sort of thing like that will run right through these pivots and it won't care. And these channels don't make price do anything. They're great guidance when we don't have anything else to focus on. Like if we had no econ today, if we weren't worried about escalations, then these channels would have more weight. It is an MDP at this point. It's a missed daily pivot. We haven't hit this pivot level. Markets generally hit their pivots, 80% of the time. So kind of have the expectation that we're going to hit that sometime today. We don't have to. There's a 20% chance that we won't. And it becomes consecutive, right? This is the very first one. It really won't count anyways until tomorrow. But then we would be also looking at tomorrow and saying, did we get another MDP and then another? This is the profile for the current week and the last few weeks. I probably should change the color. This is the color that I use for TPO, but this isn't TPO. It is just your basic volume profile. We talked about last week's point of control and how if we came down into that, we would likely see a reaction in the market. We did, but it's beyond us now. It's behind us. And we've left our own point of control a long ways back. So we're on the cusp of the drop. This is the last point of safety, the last refuge. If that 57.32 cog line breaks, then we're very likely going to go down to 5,700. It's an air pocket of risk, and I'm surprised it even caught and held here, but it did. We can look at that, those candles, all that volume here. They stepped up and they really defended that level. But it didn't stick, and we're grinding our way through it. And we can still see some of that defense. And we're not out of the bottom yet, so it's still holding for now. But think of it very much like going over to a box of pizza, right? You flip the lid, you grab a slice, your buddies grab a slice. Every time somebody goes and flips the lid and grabs another slice, there's just less and less pizza until at some point there isn't anymore. Well, same thing with the liquidity down here. If this is just an X amount, let's just put a random wild number on it. 1.5 million contracts down here. And every time we go down, we grab another 500, 1,000, 1,005, whatever it is. We just keep taking more and more and more liquidity off of this level. At some point, there won't be any liquidity left. And price will have to go lower to find it. The next major level that could perhaps provide that liquidity is down here at that 5,700. Beyond that, got a really nice drop into 55.50. And I've mentioned this more than once. That's the air pocket that I'm really concerned with, right? This is just a complex topping pattern at this point. This is nothing. 5,700 is just a decent pullback. Puts are really cheap right now, all things considered. So I mentioned we're under the 10-day. We are resting on the 3-week moving average. Tagged that in the overnight. Hit it yesterday. We got the 20-day below. Then the full ADR, 56.92 cog line. Volume's looking good. We're at 88 this morning. 80, 60, 70, 80 again. These are good normal numbers. So we're not seeing extraordinary volume and we're not seeing them sit out. It's the only thing we really want to see is that either one of those. If it's normal, it's just another day. If the volume was really light, we'd want to check and see if they're hedging. We would see that because we would see a market maker move label up here, and we don't see that label. They're not hedging, or at least they're not hedging big enough to cause the label. $10-day, 30-minute volume profile. This point of control is not expected to move anytime soon. We have at least another half a week, maybe a full week before this moves. To get it to move, we're going to need to stay in one spot and really build up some structure. We haven't had that yet. So, we're not going to get anything out of this anytime soon. We did reciprocate from one side to the other. So at this point, we haven't left the zone yet. And I did mention yesterday, it won't act as any sort of support or resistance until we leave the range completely and then come back to the range. All we've done at this point is got on the bottom what we got on the top, reciprocation. I think yesterday fits the bill for a pretty good volume profile picture. If you're trying to collect some, there's a classic B shape profile. This morning we have our classic B, and it's really a tight range. Point of control and TPO lined up equally. There's no real surprise down here. We don't see anything along the lows, like we didn't hit any sort of iceberg or anything like that. It would have been significant to see this point of control down here, right? That really would have given some heads up, or if we found it across the high. But it's not, it's inside the basic D shape. So no, nothing. As for the VPOC, if we were to put on the point of control from yesterday, we've already hit it. Now the books will tell you to do it, and I'm not against that. If you follow the books, you would draw a line at the point of control and the value area high and the value area low. And those three lines would inform you about today's trading. There's nothing wrong with doing this. I just already have enough pivots. I don't need these, so I don't do it. The only ones I carry forward are the ones that we have not hit yet. So for an example, yesterday, before we fell, we had this VPOC here because we had not hit it. Then we got the news and we ran right through it like it wasn't even there. And now we're done with it. It wasn't even a speed bump, man. We just cut right through it. These candles are white to signal the first day of the month. As much as there's an open range strategy for intraday trading, there's also one for the higher time frames. And I think maybe 5 months ago or so, I mentioned that I had read about this old school open range concept that focused on the first day of the month. Somebody else had taken that concept and added 2 more days to it, and so it was a 3-day range. Well, I like acronyms, and if you take day 1 open range, well, that's door, DOOR. So these are the door candles, day 1 open range. I built the indicator, and on equities, it really does provide some insight. Apple, SPY, Microsoft, ETFs and equities, it does good. For the futures, no, it's not useful. I haven't found any value out of it for the futures at all, but I did all that work to make the indicator, so I'm using the darn thing, whether I think it's providing any insight on the futures or not. That's not my concept, by the way. I didn't create the door strategy or system. It's old. It's been around for a long time. Check it out. Google it, see what you find. It's an interesting read at the very least. We are still within the week's range. Gotta kind of have the assumption that if we break today's low, break yesterday's low, should say it that way, that we are going to go down and hit this weekly expected move, which is 56.98. I mean, come on, that's 5,700. So I think that's a pretty good bet, right? We break yesterday's low, we really start to expand. We've seen the profiles, the points of control, we've lined it all up. If we break this low, I think it's a pretty good shot that we're going to go down to that 5,700. It would also not be much of a surprise if we overshoot that a little bit and get into 56.92 cog line, which happens to be the low from 919. That was the Thursday after the FOMC day. And, you know, if you've read anything about Brian Shannon or his anchored VWAPs, you anchor the VWAP to events. That's one of the things that you can anchor it to. You can also anchor it to high volume candles and, you know, the start of a new week, start of a new day. This would be an anchored VWAP location. So it's worth considering that too, right? And if you haven't heard of Brian Shannon or VWAPs, check it out. I think you'd be surprised. I'm not, you know, beating the drum saying that VWAPs are the greatest thing since fire was invented and anything like that, but I do use them for targets. So when I was calling the flip yesterday and, you know, kind of lining up, if we go up, where do I think we're going to pause? VWAP was the target. It was the destination. So, you know, it does provide value and insight. And that is an anchored VWAP. It starts at midnight. You can anchor them for each new day, the new week, the new month. And then, of course, high candle events and high volume events. Yeah, I like that. I know you're gonna patent that thing, aren't you? VWAC. Bitcoin down again. Jets. You know, I kind of expected a little more out of the airlines to take advantage of this shipping issue, but we're not seeing it come through yet. Trucks and rail seem to be doing good. Of course, shipping isn't, but you would think jets would get a little bit of it. They're not getting any of it. The Mag 7 group is down. Gold, precious metals, or at least the miners are down. And Bitcoin. Looking at what's up. What's up? The dollar, the VIX, China, again. China's up 23% in the last 5 days. The China Internet ETF, KWEB, but overall, just China, you know, the MCHI is up 15% in the last 5 days. And the Hang Seng, 17%. These are some fantastic numbers, but the VIX is up almost 28%. So, yeah, over the last 5 days, we've really seen things, you know, get shook up a little bit. Oil and gas just really waking up. And don't try to catch that falling knife, right? You could try to short it from here, but it can go higher easy, right? We're not done yet. And so I wouldn't try to short it yet, but don't get too comfortable in your longs because these events don't stick around forever. All right, so China leads this morning. Behind that, we've got crude and then emerging markets, which is China again. And it just irks me every time I say that they're an emerging market, because they're not an emerging market. We need to take that classification away from them at some point. That's like saying Europe's an emerging market. Come on. Energy behind that. So it's China and then energy and then more China and then more energy and energy and that gas, pot stocks, a little bit of commodities, ag, silver. You're at that point, really past VIX, it just falls off. So we wouldn't count these others, and they're not up enough. So everything that we've got in the front end is all energy and China with a little bit of pot stocks thrown in there and the VIX. You don't want a market rally on pot stocks and China. So kind of need something. All right. And then this ain't it. This ain't what we're looking for. Bitcoin, airlines, small caps down the most. Behind that, some of those safety plays like XLU. Miners, a little interesting to see why they're down when some of the precious metals are good. And bonds are almost down enough to meet our qualifications. Not yet. This structure really needs to hold here, or I think it can get a lot uglier. It's kind of going in the wrong direction of what everybody thought, bonds and yields were going to do. All right, so I mentioned I was bringing this back again. I used to do this every day, and then they changed the screener around, and I just kind of let it go for a while. I am using the S&P 100, not the S&P 500. I know the first day I did use the 500, but I was in a rush. I was trying to get it built, so I've adjusted it. It's the S&P 100. We're looking at pre-market change greater than 0.5%. But look, I only use the 0.5% because I'm doing this at 8 o'clock in the morning, right? I got to get the morning briefing done so I can get on with my day. On your own, if you come back in here and you do this closer to the market open, be more aggressive with this. Bump it up to 1.0 or maybe even 1.5. I like 1.0 because I'm looking for breadth. I'm not actually looking for a particular stock to trade, right? If you're looking for things to trade, either from a contrarian point of view or because you want to get on the bandwagon, bump it up to like 1.5. And if you still get a lot of names, bump it up again to 2.0. That way you really cut the list down and you're not trying to trade, 15 names at the open, because that's the alpha protocol play. And well, this isn't the format for that. I'm using this for breadth, kind of asking the question, how bullish are we? Because sometimes it feels really bullish in the mornings. The S&P will be up, the NASDAQ will be up, and we just get all the talking heads on TV talking about how great everything is. And then you come in and look and maybe find 7 names are up 0.5%. Well, that's not very bullish. On the other side of that, it can also be bearish in the other direction. How many names are down at least 0.5%? And since we're using a 100 number, we can also say this in percent form. It's something that I really like about using the S&P 100 and the NASDAQ 100. 17 names are down this morning. Convert that into percentages. 17% of the S&P is down this morning, at least 0.5%. I like that a lot better. Now I can correlate it against other markets as long as I continue to use percentages. All right. 17 names isn't very bearish either. So while it kind of feels negative out there, this isn't really all that bad. I'm looking for more than just the numbers. I do want to know what groups or industries are up or down, not just how many of them are down. Is it a lot of retail? a lot of transportation, healthcare, some of the Mag 7 space, a lot of growth names, value names. So, you can dig deeper into this and get more out of it. It doesn't have to just be how many names. I do like that as a good starting point because simple works. If I'm looking for overly bullish and overly bearish market dynamics first thing in the morning, how many numbers do I have here? What, 17? No, that's not very bearish. Done. I move on to the next thing. Don't have to spend a lot of time looking at this. But you can, that's my point. You can dig deeper and take it a lot farther. Add in these columns things like sector or industry, and then sort them by their sector or industry to see if there's anything that really stands out. Especially if you're day trading, equities rather than futures and you're trying to pick what you're going to trade today. Looking at it this morning, really there's nothing. There's no overwhelming majority on either side. Nothing stands out. Hotels, casinos, some payment systems, see some growth in here, semiconductors, Mag 7. So, we need to see that turn around if we're going to get any sort of rally in the market. And the heat map is useful. I know that, the first time I ever come across one of these heat maps, I thought, this is so silly. What a waste of time. Who even decided to build something like this? Because I just didn't see the value in it. Time's gone by. I've adjusted my point of view. These heat maps are pretty awesome to get a feel for what's going on out there at a glance. Right? This isn't your trading vehicle. You're not trying to zero in on these things. You're just trying to get a feel for the market. And you can see it this way, or you can squint at a watch list. I'm getting old. My eyes don't like squinting at watch lists as much as I like glancing at a heat map. And it's color coded, so it's pretty. The one on FinViz, I think, uses like blue and purple. You go purple and white, K-State, The size of the boxes represent market cap, so the Mag 7 stands out really easy. NVIDIA, Apple, Microsoft, Google, Amazon, you can just see them at a glance. Broadcom. And then, of course, it puts them into their categories or groups, and you can adjust this, if you want to dial in, maybe knock some things off that you're not interested in. Tesla is giving a bit of it back. And Apple continues to get negative news. They're really dropping the ball with that AI promise being built into their phones. And I heard this morning maybe they're going to come out with a cheap Apple phone. Again, a new SE version. Yeah, we'll see. If I remember right, they didn't do good with the sales the last time they created a cheap version. I don't know why they keep coming back to get kicked again and again. So it's pretty simple at this point. We've got a reasonably narrow range. We're trapped between two major moving averages. We're waiting on data, and the data is going to be the driver of all of this. The market very likely is going to get good job numbers news, but it's going to be offset by the tensions in the Middle East and waiting for a potential retaliation strike. And so I would expect that headlines move markets today, and just watch the clock. I'm more bearish than bullish since we're already this close to the edge of yesterday's range. It's more likely that we hit the lower edge here, this ADR low, and maybe the 20-day moving average before we do anything else. So that puts me in a bearish posture to that level. I still don't see any reason that we break under 5,700. Just remember my warning if we do. And I'm not talking about to the tick penny here. We can wick down underneath it. We can go to 56.92 cog line and find structure and rally back up against 57 and back above 57. So just because we stick our toe on the other side and we get under 57 doesn't mean we're immediately going to just drop all the way down. We're waiting on the spot gamma founders note for this morning, and I'm pretty sure they're going to say that we're in negative gamma in a couple of different markets of importance, like the Qs. And the thing about gamma, if we're underneath that flip point, if we're in negative gamma, it's dealer gamma that we're worried about, right? When we're in negative gamma and the dealers are not neutral in their position, that's where they want to be. The more we fall, the more they will sell. And of course, they're selling. That makes us fall. The more we fall, the more they sell. That makes us fall. The more we fall, the more they sell. You see the loop, right? We just keep doing that. When we're in positive market conditions, when we fall, they buy. When we rise, they sell. And that stops things like really big rallies from getting out of control. But when we're in negative market conditions, they make the situation worse. The falls are more exaggerated. The recoveries are less pronounced. So if we are in that negative gamma environment and we break that 5,700, we could really dump like flash crash style into 5,500, 5,550. Everybody be careful, be safe, have